It's been a minute.
Yeah, no kidding, right?
Crazy. All right, everyone. Welcome to Portfolio Toss, where we bring the conversations about money right to you through your screen. And today we're going to be talking about debt, the good, the bad, the ugly when it comes to debt. And it's one of those things that is talked about and kicked around often, but no one really knows about debt until they're in a really bad financial situation and they're like, okay, I get it now, but it's really, really difficult to get out of that problem. So, first thing is if you're watching this and if you want a debt calculator, we have one that we use at Portfolio Planning that we'd be happy to send to you. If you just email us at info@portfolioplanning.ca, we can send you the debt calculator. And this is really good for someone who has multiple lines of debt, let's say line of credits, credit cards, and you want to get an idea of, lining up your debts, what your payments are going to be, and then how quick you can be out of debt. And it'll give you very specific dates as long as you stick to that schedule. But yeah, if you want that debt calculator and worksheet, let us know info@portfolioplanning.ca and we'll send that over to you. But Tyson, what's going on? Let's catch up before we jump into it.
Yeah. It's been it's been really busy end of the year for us. And it's just like, there's not enough hours in the day, there's not enough days in the week. It's a great feeling because in the summertime nobody really wants to talk to us, and so we can work as much as we want, but it doesn't feel really busy. Um, so this is kind of like the time of the year for financial advisors to catch up as we go into year end. It's like, hey, what did we do this year type of questions and some tax planning kind of questions. And we're trying to fit everything in to 2024 so that clients can like have a clean break and then go into the next year and hopefully start it off in a good way.
Yeah, 100%. And I think there's so many things that are timely, which it's always funny. We talk about it every year, but in November, it's always the busiest time of the year. It's like our Boxing Day, Black Friday kind of thing. And December, we're quite quiet, but I think it's a lot of times that we talk to people in the summer and they know that they need to get these steps implemented, but life happens, they get busy. Something about November when it comes around, they're like, oh God, the holidays are coming, the end of the year is coming, New Year, New Me in January is coming, so they want to get all this stuff done ASAP. And then it's kind of the start of RSP season. So before the calendar turns, people start thinking about their RSP contributions, corporate year ends. If I need to fund my FHSA or open up my FHSA account, there's so many things that come up at the year end, and every conversation is different. So I agree with that sentiment. It's been crazy, but let's jump into it. So today we want to teach everyone about debt. So if there's Canadians that are watching this, and I preface this by saying Canadians because what we talk about for the vast majority of it is Canadian content, which is refreshing because for us, every time we're trying to look out for stuff online, everything's American. But for Canadians out there that want to understand the different types of debt, let's start off there and then we'll kind of talk about the leverage for or how to effectively leverage different types of debt, how to consolidate debt, and things of that type. So first off, different types of debt. What's your perspective on different types of debt? What's out there?
Yeah, well, I guess one of the easiest ways to kind of categorize this is the easier debt that you have access to is usually worse for you. Um, so just think about like uh, 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 if you're in a bad position and you go and get a payday loan. Some people have got to do it because life blows up in their face, but that's probably like the worst kind of outstanding debt that you can have, and you don't want to owe like a loan shark or a payday guy or anything like that because they charge astronomical rates, worse than credit cards, right? And so most of the time when people can think about bad debt and put all that together, it's usually for consumer purposes. So you bought a car, you bought stuff on your credit card. We now live in a society where it's buy now, pay later, and everything's got a payment plan. And you can buy these, sweatpants and 4 easy payments, and you think, why are we making payments on simple things? And I think it reminds a lot of us that going back to basics is a really good thing. And some of that advice that we got from the grandparent generation and our parents' generation is they came out of a depression era where they didn't really spend money on things. They bought one thing and he made it last for a long time. Whereas, now we, even if you don't participate, we are affected by that hyper fashion, whatever they call it, um, genre where, you buy the clothes to wear it once or twice and then you're going to throw it out. You're not even going to own it for a long period of time.
Yeah.
And so the industries are really good at separating consumers from their money, and that usually leads the road to bad debt.
Absolutely. I think the big thing is that consumer centric economy, and you know the real benefit for a lot of these companies, like these banks, these credit card companies, or whatever, is they want to have from the economy money circulating. And like, oh, it's good for the economy, get money circulating, and that just basically means like spend money because if in theory, if I spend money at a store, at Tyson's store, Tyson's going to take that money, spend it on something else. That person's going to take that money, spend it on something else, and that money just circulates and keeps the economy going. That being said, I always joke about this. I heard this during COVID. Everyone's like, support local business, support local business. I'm like, man, like people need support too. You can't just give all your money to local businesses and just hope the economy is going to just magically fix itself because you're going into credit card debt.
Yep.
You want to be very conscious of what you're spending. And I think the fast fashion is one thing I notice a lot. It's crazy how much money people spend on things that are totally irrelevant. And when you ask them, what do you enjoy doing besides work? And that's really like a qualitative question to understand, like, what's important to them to spend their time doing. And none of it is aligned with what they spend a lot of their money on.
Yeah.
I've seen clients that work with us and they spend a ton of money at like Aritzia or Lululemon or just in general, like buying random things. And we ask them what do they enjoy doing and what brings them a lot of value. Reflect on some of your best days, and it has nothing to do with what they're spending their money on. And it's just you get keeping up with the Joneses, get caught up on something. It's convenient. You look at something on Amazon, all of a sudden you get push notifications of also buy this, one time sale. And then you're, oh, okay, cool. I don't even have to pay for it now because, like you said, there's four easy payments of $14. Oh, well, I don't even got to pay for it now. I'll just pay for it later.
Yep.
It's just very, very ugly. So I think the different types of debt, what you said is so good. If it's easy to get, it's probably really bad for you. So payday loans is like the worst thing ever. After that, I would say like credit cards and also store credits. So if you go to like a Costco, Home Depot, Canadian Tire, I'm assuming all of them have their own store credits. I don't even know for sure. I know Best Buy does. But all those kind of credit cards, store credits, those are all really, really bad for you and can easily get you into the spending habits of spending more than you need to spend. Whereas you had $1,000 budget, oh, now you can finance it. Okay, well now I can justify spending $1,500, $1,600 because I'm just gonna pay a certain amount of months, and it doesn't really make much sense. And then going into line of credit. So, what's your perspective on line of credits?
Line of credits are like a double-edged sword. It's like a really, really good sword. So you can use the line of credit for very good purposes for investment. For some people use it as an emergency fund. You can use it to buy a rental real estate. You can use it to run your business. But it also allows people to have access to something, especially if it's a home equity line of credit. You're spending the equity in your home, and then you have three cars in your driveway, and you have a boat, and you might have a cabin, and you take some vacations, and you don't really feel the sting of having to build that money muscle and have that delayed gratification versus if you were trying to do it all through budget and through cash flow control and that kind of stuff. It can really hurt you because it makes spending painless and very easy to max out your line of credit quickly. And then what most people don't understand is that it takes time to get into debt, and it also takes time to get out of debt. You can't just go to your financial planner and say, "Hey, like fix my debt." And that question a few times a
People have
year.
tried, yeah.
Yeah. And there are things that you can do to make it better and more efficient with your dollars, but like I don't have a magic wand to wish that away. So it is a double-edged sword, but having a good line of credit is something that maybe we can use in your strategy to be very efficient. So an example is you have a line of credit, it's empty, you have a 6 to 9% interest rate on your line of credit. That's good. You have some credit card debt and you are paying it down and you're going to pay it off soon. So it's like, why don't we pay off the credit card with the line of credit, and then we're slashing your interest in half. You can pay that down quickly, but don't go and rack up your credit card again instantly because it's free. So it's cash flow management.
Yeah, I always say that the line of credit and how people use their line of credit is so indicative of their behavioral finance. And that's one of the first things we look at when we start onboarding new clients is we look at what access to debt they have. And we'll look at the line of credit because the line of credit can tell you a lot about how they approach their finances. So Tyson, to your point, you could use the line of credit for 100 different things. You could use it for investing, you can use it for an emergency fund, you can use it for financing or consolidating debt, and anything kind of in between. So how that line of credit is used tells us a lot about their prior decisions or their philosophy on spending money. And we actually just had that this week. We had a client who has about $60,000 on the line of credit. And we just asked them, I'm like, all right, cool. So tell me a story about the line of credit. Like, how'd you get the $60,000? And one of the clients this week was basically overflow from credit cards. So they'll overspend on their credit card for on vacations primarily. And once they have that, they'll overspend, but then they'll just take the line of credit and pay off their credit card. So in their mind, they're like, okay, I don't have credit card debt. But really you do. You keep pushing it over to your line of credit. And in essence, you have like a $50,000 credit card debt. You just have a lower interest rate on it because you have your line of credit. So that was one client. Another client we asked, well, they have $100,000 in line of credit. So tell us the story about the line of credit. For them, it was just paying off student loans and they consolidate into that. That's very different. And then we have other clients who did that, use it for renovation to make their basement suite suitable, if that's the right word. So you
Yep.
can rent it out to a tenant. Okay, cool. Now that's going to appreciate the value of your home and they'll consolidate later. So just right there is three different examples of three different clients just this week and three different ways that they've used it. So, line of credits are great, but you got to be very careful on how you use it because, like anything, sometimes your best asset can also become your worst liability
Yep.
if you're not smart with how you use it. So you got to be very strategic on how you use it, ask questions, and set up a plan before you get that line of credit. So many people go to the bank to deposit your tax return. Let's say it's RSP season right now, so you're going to do a deposit into your RSP and your FHSA, so you're going to get a good tax return come tax time, get a tax refund, you go to deposit it in the bank, and right away they're going to offer you something, whether it be a credit card, overdraft, another bank account, and sometimes it's going to be a pre-approved line of credit. So they're like, oh, no, don't worry, it's not going to hurt your credit. It's not going to hurt your credit. That's always a quick thing that they say because that's why people push back right away. And that's true, but they really want to give you opportunities to fail. So before you open any line of credit, just make sure you have a strategy. And if it's you and your significant other, make sure you both talk about what the strategy is going to be. And hey, like we're not going to use this line of credit unless it's for this and this and this. We're gonna have two signers on it. We both have to agree to you put money on it and whatever that may be. So have a plan with your debt, or else it can really get out of hand. And the philosophy behind that is such a hard thing to change because we can't just come in there and wave our magic wand and be like, all right, all your problems are solved. We can help correct your behaviors, but that takes time as well. And
Yep.
like that debt calculator I talked about earlier, it's not a quick thing, but it can be done. But you just don't want to put yourself in a position where you're behind the eight ball trying to climb uphill when it comes to debt because compounding debt can really, really hurt you.
Yep. Exactly. Exactly. So.
So with line of credit, we can also leverage that. So you alluded a little bit about rental property. For the people out there that don't understand, first of all, what leverage is, and second of all, how can you leverage your line of credit? What does that mean? Hit with some knowledge.
Yeah. So leverage is essentially is you're going to have a small position and you're going to use it to access a bigger position or another position, something else. It's just a lever. And so in terms of using line of credit or access to debt for you to leverage something, the example that we see a lot, especially here in the Vancouver area, everybody's a real estate investor. So you buy your principal residence, you work really hard, you pay down your mortgage, and then you take out a separate line of credit on your home, usually, and you go and you're going to buy a rental property. So you're going to use that to expand and buy additional real estate. And where we see people grow and do this is they will buy something. This in the Vancouver area, it's a little harder to do this. In the rest of the country, you can't do this. You'll buy something that's a little distressed. You'll fix it up. You'll refinance after you fix it up because you've increased the value, and then you go and you do it again, right? And so like online on social media, they call this the BRRRR method. So it's like buy, rehab, refinance, and then repeat. It's harder to do that in the Vancouver area and in the Toronto area because the barrier to entry is so high. You're going to buy a $1.5 million teardown, and then rehab it for another $300,000, and then like, man, you can't rent it
Not
out
to
for.
mention the permit process here is brutal.
Yeah,
In BC, anyways, it's horrible. It takes so long to get any kind of permits done.
exactly. In the rest of Canada, I think that that's still doable. For instance, I have clients that are in Atlantic Canada, and their property value is based on the home, not the property. So it's flipped. So it works very, very well for them there to go in and buy a $300,000, multi-acre property, which is like, it hurts to say. You can go buy a really nice house that's 100 years old, and they'll do electrical, they'll do all the facelift on the house, make it look nice, and then you can get another 40 or 50 thousand dollars value out of it, and then you can rinse and repeat.
That's crazy. Yeah, I think it's insane. We look at the difference of housing prices, and that's one example of how you can leverage debt to effectively build your wealth and start to increase your net worth. Another way you can do that is something called an RRSP loan, and I think we talked about it a little bit last week. But exact another example of leverage where you take a small amount of money to get access to a larger amount of money to do something with. So if you're out there and if you look at your notice of assessment, which can be found in your MyCRA account or you get mailed it at the end of your tax year anyways. But if you look at your notice of assessment, it'll tell you what your RSP contribution room is. So it's going to be potentially from the last year, but it could also have carryover room for several years. So if you haven't deposited for many, many years into your RSP, let's say, for example, you have $100,000 that's available to you in your RSP room. And the first very important step is to check your MyCRA account to make sure you have the right contribution room because there's penalties and all that stuff if you get it wrong. So you check that, you look, I got $100,000, but I don't have $100,000 of cash to invest in it. Maybe you're around 40 and you're worried about retirement and I can maybe deposit 1,100 bucks a month, but I don't even have access to that kind of cash, and it's going to be difficult. And then your investment is only growing on the $1,100 a month that you keep putting into it. Alternatively, what you can do is leverage and get what's called a RRSP catch-up loan. And you can get this from many different banks, many different insurance companies. You could use your line of credit for this, your home equity line of credit. And basically, what you want to do is get access to the $100,000. So instead of investing $1,100, you can finance whatever that $100,000 is going to be. Let's say it's a 5-year plan. So you're going to take that and use your money instead of investing it monthly to finance this debt. And you'll take the $100,000 and invest it all at once. The first benefit is you put into your RSP, you're going to get a huge tax return, most likely, and you can take that and pay it back onto the loan. So you borrowed $100,000. Let's say you get a $15,000 to $20,000 tax return. You can pay that off automatically because a lot of these loans will have repayment options. So it's not like you have to pay it off for the entirety of the 5 years. You can actually do a lump sum deposit on there and just make sure you check those terms because you want to make sure you have one that will allow you to pay it off in lump sums. So you can get the tax return, drop it onto your line of credit. Now you only have $80,000 left. You're going to finance that $80,000 for 5 years, and now your $100,000 is going to grow within your RSP at a way faster rate than it would have if you were depositing $1,100 a month. And that can be the difference of you retiring at 65 or retiring at 75, because compounding has a tremendous, tremendous impact. That's also an option you can look at if you are refinancing. So, if someone who bought a home and your renewal is coming up and your property value has gone up, you could potentially just refinance your property at lower rates and then have that cash on hand because it's not taxable. And then you can pop that into your RSP and turn non tax money, aka your refinanced income, and drop it into your RSP and get a tax refund. So, you can kind of get a double dip when it comes to being tax strategist,
Yeah.
and you're not evading tax, you're just using the Income Tax Act. And that's a very important thing to remember. You don't want to evade tax ever. You want to make sure you're following the Income Tax Act and using the benefits that they allow for you. So that's another example of how you can leverage debt. So many, many ways that are out there. We should always say that this isn't financial advice because we don't know anything about your situation or who you are or what you do. So it's important that you take a look at your own situation and see what makes the most sense for you. Do all your due diligence on our website at portfolioplanning.ca. We have a debt calculator that's on there as well. So you can access that and type in a bunch of different numbers and see, what that would look like if you did an RSP loan and borrowed $100,000. What would that look like if you refinance your home and add another $100,000 on debt? A bunch of different scenarios. You can plug all that information, and it's on our website at info sorry, at portfolioplanning.ca, and you can access all that stuff there.
Yeah, I think
Um,
to add one thing
yeah,
to that is this is financial advice that I give to my clients. You're going to do that, and you're going to get a really large refund come April when you file your taxes. Please file your taxes. Um, do not, do not, do not increase the size of your TV or buy a new boat with your refund because you become less efficient. You have the opportunity to max out your tax-free savings, to max out, you can maybe use the refund for RESPs for your kids. You can do a bunch of different things for it to create efficiencies with the same dollars. Um, but yeah, most people get this refund check and they think it's free money, and instantly want to spend it because they think it's free money, but it's actually your money being returned to you. And we want to look for the place where it can be the most advantageous, right? So in a presentation we just did with a group, we were showing them, hey, if you're at 35 and you had to, take $10,000 out of your savings or out of your investments at age 35 to pay off your credit card or something, it's actually worth $100,000 at age 65. And so if you're getting a nice, really large tax refund and you're in your 30s, man, you can spend that on a bunch of things. But if you invested it, that could be an extra $100,000 at age 65. And you know, the 65-year-old you would say that trip wasn't worth the extra comfort and security in retirement.
yeah, 100%. I think that's another example of how sometimes your best asset can quickly become your worst liability. And it may not seem like it in that scenario, like, oh, I just spent my money on my tax return somewhere else. But if you look at the compounding effects of that extra $20,000 that's on your loan, where you could have paid that off with the tax return, but now you bought another liability like a boat, worst thing you could buy. But let's just say you bought another liability like a boat or another liability like a car. Now you just really compounded that problem. So it's very important in these definitive moments in your financial journey that you make the right decisions. And these are what financial planners can help you with. This is what doing due diligence can help you with. Just making sure that when those pivotal moments in your financial life come, you make the right decision that makes sense from a bunch of different lenses. It's going to help you save for retirement. It's going to help you save for your kids' education. It's going to help you save for a rental property that you can use to retire on, whatever that may look like for you, because that $20,000 could be, deposit on a pre-sale. It could be a bunch of different stuff, and that's a whole different conversation if pre-sales make sense or not. But we're going to talk about it in another episode. But the importance of filing your taxes. Just had a client that signed up with us, and she hasn't filed her taxes in many many years because she's paying her taxes is fine. She's like, I'm not gonna have a tax return, so it don't really matter. I don't owe tax. If anything, I'll have a small return or whatever. But the biggest thing is she had kids, so I'm like, if you're not filing your tax return, you're not getting your child benefit, and that's extra money. So there's a lot of benefits and credits that are out there that you need to file your taxes in order to get access to. And I'll leave it there because I don't want to go too off topic, but it's very very important. Like Tyson said, file your taxes, whether you think you owe or not, whether you think it's important or not. File your taxes because you don't know. For example, when it comes to leveraging debt, sometimes those lenders will want to see your tax return for the last couple of years, and if you don't have that and you need the debt, it's not a quick thing to do to catch up on all your tax returns you haven't done yet, file it, get the reports back to them. So sometimes when you need that, you need to have your, what is it called? Eggs in a row? Is that the
Yeah,
saying?
yeah, yeah.
Oh
Uh,
wow,
your
totally
ducks in
shot
a
in the
row.
dark there. Ducks in
Yeah,
a row. That's that's what I meant.
I know what
So
you
you
meant.
want to have your ducks in a row prior to needing something. So before you go to the bank, like I need this line of credit, you want to make sure that your ducks are in a row and you have all that stuff lined up. So it's a quick process as opposed to being shut down. And being in a situation where you can't get that debt, or you have to go to a payday loan or a credit card or alternative lending, you don't want to do that as well. So yeah, when it comes to debt, the good, the bad, the ugly, just make sure in summary that you're understanding the different types of debt. And I think Tyson said it perfectly. The easier the debt is to get, generally the worse it's going to be for you. And by that, we mean it's going to charge you higher interest rates or not favorable to you, but more favorable to the lender. So you'll be very careful about that. Your line of credit can be a great thing or a horrible thing. It all depends on the strategy that you use for it. So make sure that before you get access to that debt, before you get that line of credit, you and your significant other, you guys have a discussion about what this line of credit will be used for. Maybe you both have signing status on it. So you both got to sign off on it prior to using it, and just make sure you have a plan in place. And when it comes to leveraging that line of credit or leveraging your home equity line of credit or any kind of loans like that, you could do things like taking that to buy investment properties, but make sure you do the calculations and make sure it makes sense for you. And then you could also take that to do an RSP catch-up loan, get a huge tax return, be smart about your tax return because you can use that to pay off the loan or buy another asset, but you don't want to use it to buy a liability or something fun. And then the last thing I want to teach you guys about is checking your credit score because all this is predicated on your credit score. If you have a really bad credit score, you cannot get debt, and your only options are going to be the predatory lenders in the very beginning that we talked about. So, Tyson, where do you go or where can someone go to check the credit score, monitor the credit score? What's out there?
So there's two main credit bureaus in Canada, and you can access them through their website. Like one's called Equifax and one's called TransUnion. But there's other free services that are available now because of the internet and stuff. So I've used and I direct clients sometimes to creditkarma.ca. It's not an advertisement or an endorsement, but it's a free service and they're pretty good about what they monitor. The challenge is because there's two credit bureaus or credit monitoring companies in Canada, is sometimes they report things differently, and you can have two different credit scores um, looking at two different places. And so when you're going to apply for credit, say you're going to finance a car or you're going to go to your mortgage broker and apply, you don't know which one they are drawing credit information from. And it may turn out to be more favorable for you and it may not. And so I don't have really a strategy as to how to pick, but there are two out there and they report a little bit differently.
Yeah.
And if you want something for free, there's a few online services, but I've used and I recommend Credit Karma.
Yeah, yeah. Credit Karma is good. Borrowwell is another one that's good as well. But yeah, we've had people in the situation where different banks will use different lenders, and it's not going to vary a huge amount. Like you're not going to be 800 on one and like 680 on the other one,
Yeah.
but they will vary a bit. And if you're on that little cusp, then it can be tough because that can predicate what kind of rates you get. And there's no real strategy because you don't know what lender you're going to end up going with, so you don't know what to ask them. Like, hey, who do you use? And I'm going to check that one. But in general, just the good thing about Credit Karma, Borrowwell, they'll give you like health checks of basically like what's good, what's bad about your credit. And a lot of the times, what I realize that people make mistakes on that impact the credit in a negative way, besides the basic like pay your bills, is utilization rate. So making that sure that you understand utilization rate and you're using a good amount of your credit. So you don't want to have like a max out. You don't want to have like a $1,000 credit card limit if you're a student and then you're using $800 all the time. You don't want to be utilizing a ton of your credit, and then you also don't want to be canceling credit and reapplying for a bunch of different credit all the time. Longevity is a really good story, and I think if you think of your credit score as your credit story, that kind of helps with the understanding of your credit score, because it really is a story of who you are as a borrower, and that's going to position you really well to all the lenders out there because they really want to know your story. So if your story is good, you'll get better rates. If it's not good, obviously it's not going to be really good for you. So yeah, before we wrap up, anything else you want to add on?
Yeah, I thought of one worse, absolute worse credit situation in the good, the bad, and the ugly conversation. And this is not financial, but we do see this a lot. It's borrowing money for sports betting. Um, it's got to be the worst decision that you can do. And there are some reports that are starting to come out now because it's so prevalent, is that every dollar that you spend on sports betting now, it detracts $2 from your retirement.
Holy cow. I've never heard
Yeah,
that yet.
yeah. And so that's terrible. And then if you're borrowing that money to lose, it has a magnifying effect. So maybe it's 20x taking from your retirement. And it either means that you're going to need more work to have a good retirement, or you're not going to have a good retirement by a factor of 10 to 20x.
That's a scary thought. To be honest, if you want to do sports betting, just, bet funny stuff with your friends. Like, I don't
Yeah.
know, you got tee off in the ladies' tee next time or whatever it is. Like, I don't know what that's gonna be, but stay away from the money. It's crazy. I can't imagine that because sports are stressful as it is. I can't imagine throwing money on it, and every game is so important. So I would not be able to do that.
Yeah, yeah, but it's a thing now. It's a whole genre that it didn't really exist in the mainstream 10 years ago. And now it's every other advertisement on TV or on my phone. It's a sports betting company. And
You
people
can bet
just,
on everything nowadays.
yeah.
It's great. There's sports, MGM Grand Casino might have a thing on Portfolio Talks. Like, is it going to be over under like 35 minutes or something like
Yeah,
that? You
are
can
they going to
bet on
suck?
it, right?
All
So
right, this is going to be a really good episode.
yeah, bet on the over. Always bet on the over if I'm talking. So yeah, it's one of those things that you can bet on everything. It's crazy. Like I think during the campaign, like the U.S. campaign, there's bets on that of like who's going to win what states, and it's just crazy. You can bet on everything. So betting is a dangerous thing for sure, for sure. So just make sure that at the end of the day, it goes to a budgeting conversation we talk to our clients all the time about is as long as you spend on yourself and your obligations first, so your money comes in, you pay yourself first, like your RSPs, your TFSAs, investments, whatever that may be, you pay all your bills, and then whatever money's left over, it's all good. Like do whatever you want to do with it that makes you happy, whether it's go on Netflix, Crave, Disney, all at the same time. Um, whatever, sports betting, if you want to buy clothes, all good. Just make sure that you take care of your obligations first and you don't try and do all that stuff and then save whatever's left over or try and hit big on a bet and then that's going to help you save for retirement. That is a losing strategy 10 out of 10 times. So make sure that you pay yourself first and then whatever's left over, do whatever you want with it.
Yep, exactly. 100%.
Love it. All right, that's a wrap for us, guys. And if you haven't already, make sure that you like, subscribe to Portfolio Talks. We come out every single week, and the whole point of it is to make sure that week by week you're starting to understand a little bit more about your money, a little bit more about your finances, and a little bit more of what you can do to get financially ahead and bringing the conversations around money right to you through your screen at your fingertips. So we appreciate you. Make sure you like, subscribe, anything you want to get discussed comment below. And as a reminder, if you want to get that budget worksheet or check our debt calculator is on our website, portfolioplanning.ca. And if you want to get the debt calculator, that worksheet, email us at info@portfolioplanning.ca and we'll get that fired off to you.
Fantastic.
Thanks, everyone.